Friends, thank you for being here today. What if I told you that while your government celebrates victory over inflation, your family's grocery bill just got hit with an extra $1,000? Not next year, not in some theoretical future, right now, in 2026. While economists and politicians pat themselves on the back for bringing inflation under control, the mathematical reality of your dinner table tells a very different story. Let me share a number with you that should fundamentally destabilize everything you think you understand about the economy. According to the 2026 Canada Food Price Report released just last month, a family of four will spend up to $994 more on food this year compared to 2025. The total annual grocery bill is forecast to hit $17,571. That's not a projection. That's not a worst case scenario. That is the baseline forecast. And here's what makes this truly incomprehensible. This is the largest predicted dollar increase in the report's entire history. Now, the headlines will tell you inflation is hovering near 2%. The central bank will tell you they've engineered a soft landing. The political class will tell you the crisis is over. But here's the question they hope you never ask. If inflation is at 2%, why is your food bill rising by 4% to 6%? Who is lying? Is it the statistics or is it your receipt? This is not a market correction. This is not a temporary adjustment. This is a structural fault line running directly through the foundation of your household budget. And what I'm about to show you is why this inflation, the real inflation, the one that determines whether you eat steak or skip meals, is about to get significantly worse. This is a mathematical endgame, and the clock is already ticking. Let me take you back to understand how we arrived at this moment, because this crisis didn't begin with a bad harvest or a supply chain hiccup. This is the final act of a tragedy that's been building for decades. Think about what money actually represents. For most of human history, money was a claim on something real: gold, silver, labor, land. It was tethered to reality. But over the past 50 years, we've slowly severed that connection. Money became numbers on a screen. Wealth became digital. And central banks discovered they could create unlimited amounts of currency with a keystroke. Here's the simple logic most people understand. When you print more money, each unit of that money becomes less valuable. It's basic supply and demand. If there are twice as many dollars chasing the same amount of goods, prices double. Your grandparents understood this instinctively, but somewhere along the way, we were told that this simple logic no longer applied. We were told that central banks had figured out how to print money without consequences. We were told inflation was transitory. We were told to trust the experts. And for a while, it seemed to work. The money printing didn't show up in your grocery bill at first. It showed up in asset prices. Stock markets soared. Real estate went vertical. The wealthy got obscenely wealthier. But the cost of eggs stayed relatively stable, so the official inflation numbers remained calm. The inflation was there. It was just hiding in assets the average person couldn't afford to buy. But here's what changed. That printed money is now draining out of financial assets and flooding into the real economy, into the things you actually need to survive: food, energy, shelter. And this brings us to what I call the big secret of the entire system. The inflation you see in official statistics is not the inflation you experience at the grocery store. The Consumer Price Index, the official inflation measure, includes things like flat screen TVs and used cars, which have gotten cheaper. It weights housing costs using owner's equivalent rent, which dramatically understates what people actually pay. It uses hedonic adjustments and substitution effects to mathematically minimize the increases. It's designed to make the problem look smaller than it is. But your grocery cart doesn't lie. Your receipt is the real inflation index, and that receipt is screaming. Now, let me show you the specific mechanism that's crushing your food budget right now and why it's about to get worse. Canada imports approximately 80% of its fresh fruits and vegetables during the winter months. Think about that for a moment. 4 out of every 5 items in your produce section traveled across a border, and every single one of those items is priced in US dollars. The oranges from California, the lettuce from Arizona, the grapes from Mexico, traded through US markets, all priced in US dollars. So here's the question. What happens when your currency weakens against the US dollar? The Canadian dollar is currently trading in the 71 to 72 cent range against the US dollar. Let me translate that. For every US dollar of produce a Canadian grocer buys, they're paying 139 Canadian. Just 2 years ago, that same dollar of produce cost them 1.33 Canadian. That's a 5% increase in cost before the product even crosses the border, before any actual inflation in the US market, before any supply disruptions, simply because your currency is weaker. And here's what makes this truly devastating: that currency loss is permanent, it doesn't reverse. The grocer doesn't eat that cost, they can't. Their margins are too thin, so they pass it directly to you. Every percentage point your currency falls translates directly into higher prices at checkout. Your weak dollar is literally eating your dinner, but the currency is just the first layer. Let me show you what's happening with the food itself, because this is where the crisis becomes a convergence. Meat prices are projected to rise 5% to 7% in 2026. Now, you might think that's just normal inflation. It's not. This is a supply crisis that's been building for years. Cattle herd sizes in Canada and the US are at their lowest levels since the late 1980s. Not because of disease, not because of regulations, because of sustained drought across the prairie provinces and the American plains. Ranchers have been culling herds for 3 straight years. Why? Because there isn't enough water and feed to maintain the animals. And once you cull a herd, it takes years to rebuild it. A cow doesn't reach slaughter weight overnight. We're not talking about a 6-month recovery. We're talking about a 5 to 7 year shortage. You aren't paying more for beef because of greed. You're paying more because there is physically less beef to buy. And demand hasn't dropped. If anything, it's increased as economies reopened post-pandemic. So what happens when beef becomes unaffordable for the average family? They shift to chicken. They shift to pork. But here's the problem. Everyone else is making the same calculation at the same time. Demand for chicken is spiking. And guess what chicken farmers need to raise chickens? Feed, corn and soybeans, the same crops that were damaged by the same droughts that killed the cattle industry. This is what I call the protein premium. The price of survival level nutrition is decoupling from the price of discretionary goods. You can buy a 65-inch television for less today than you could 5 years ago. But the chicken breast that keeps your children fed, that's becoming a luxury item. And then there are vegetables. Vegetables are forecast to rise 3% to 5%. That might sound modest until you understand the mechanism. California produces the majority of fresh vegetables consumed in North America during winter. And California has been oscillating between severe drought and catastrophic flooding for the past 3 years. Crops are either failing from lack of water or being washed away by mudslides. The predictability that agriculture depends on is gone. Add to that the 71-cent dollar, and you have imported inflation compounding supply-side scarcity. A head of lettuce that costs a U.S. farmer $1 to grow and ship becomes $1.39 for the Canadian grocer, plus transportation, plus the markup. What used to be a 99-cent loss leader to get you into the store is now $2.49, and that's before the next crisis hits. Because there's a third force coming, and it's the one that could push food inflation into double digits. This leads us to the system's most crucial threat, which we must examine next, the trade war scenario that could turn this crisis into a catastrophe. The 2026 Canada Food Price Report includes a section that most media outlets glossed over. It's buried in the methodology notes, but it's arguably the most important sentence in the entire document. The United States trade dispute remains a wild card for 2026 food prices. A wild card. That's the clinical language economists use when they mean we have no idea how bad this could get. Let me explain what they're really saying. The current food price forecast, that $994 increase, that 4% to 6% inflation, assumes the status quo holds. It assumes trade flows continue normally. It assumes the US and Canada maintain their integrated agricultural supply chain. But what if that assumption breaks? Right now, there are active discussions in Washington about imposing tariffs on Canadian goods. The number being floated is 10%. That might sound abstract until you realize what it means in practice. If the US imposes a 10% tariff on Canadian exports, Canada will retaliate. That's not speculation. That's how trade wars work. And when Canada retaliates, it will target American agricultural products, the same fruits and vegetables Canada depends on during winter. Here's the mechanism. A 10% US tariff gets passed to Canadian exporters, who pass it to consumers. Canada responds with a 10% tariff on US produce, which gets passed to Canadian grocers, who pass it to you. You're now paying the cost of both tariffs. That head of lettuce that was already expensive because of the weak dollar, add another 10% to 20% on top. We're not talking about 6% food inflation anymore. We're talking about 15%, maybe 20% on imported produce. And here's what makes this scenario so dangerous. It's not dependent on economics. It's dependent on politics. One diplomatic tweet, one retaliatory gesture, one symbolic trade action, and the entire forecast goes out the window. We are one political tantrum away from double-digit food inflation, and nobody is prepared for it. But let me show you something even more disturbing, because the trade war threat is actually a symptom of a much deeper structural problem. The real crisis isn't the tariff itself. It's what the tariff reveals about the fragility of the entire system. Canada doesn't produce enough food to feed itself year-round. That's not hyperbole. That's a mathematical fact. During winter, 80% of produce is imported. Think about the vulnerability embedded in that number. Your ability to feed your family is dependent on the smooth functioning of international trade, stable currency exchange rates, and cooperative political relationships. When any one of those variables fails, the cost gets transferred directly to your kitchen table. This is what I mean when I talk about the illusion of stability. For decades, we've treated cheap, abundant food as a permanent feature of modern life. We assumed the supply chains were robust. We assumed the currency would hold its value. We assumed the political relationships would remain functional. But all of those assumptions were built on a foundation of historically abnormal conditions: cheap energy, stable climate, and cooperative globalization. Those conditions are evaporating in real time. Let me give you a specific example that proves the rot is already spreading through the system. You won't have heard about this because it doesn't make headlines, but it should. In late 2025, A company called Tricolor Financial filed for bankruptcy. Tricolor was a subprime auto lender. They financed car purchases for people with poor credit. When their credit lines froze, they collapsed within weeks. Now you might ask, what does a subprime auto lender have to do with grocery prices? The answer is everything, because the same credit freeze that killed Tricolor is spreading through the entire economy. When credit contracts, businesses can't finance inventory, grocers can't stock shelves, farmers can't buy seed. The whole supply chain seizes up, not because of a shortage of goods, but because of a shortage of liquidity to move those goods through the system. And this is happening right now. Look at what's happening in technology stocks. NVIDIA, the darling of the AI boom, has seen its stock price crater in recent months, not because AI is failing, not because their products are obsolete, but because liquidity is draining from the market. Investors are pulling money out of speculative assets and hoarding cash. That's not a sign of confidence. That's a sign of fear. Or look at Bitcoin. Bitcoin was supposed to be the hedge against inflation, the digital gold, the safe haven. But when liquidity contracts, Bitcoin doesn't act like gold. It acts like a tech stock. It crashes. Because Bitcoin isn't a store of value in a crisis. It's a liquidity gauge. When it falls, it's telling you that real money, the money that buys food and pays bills, is disappearing from the system. This is the canary in the coal mine, friends. The assets that were supposed to protect you are failing. And the reason they're failing is because we're transitioning from a world of paper wealth to a world where only real assets matter. The numbers on your brokerage statement, those are claims on assets. But when the system is under stress, claims can vanish. Only the physical, tangible assets remain. So let's walk through the logic systematically, because this is where most people get trapped by their own normalcy bias. You might be thinking, I'll just hold cash. Cash is safe. But is it? The Canadian dollar has lost 29% of its value against the US dollar over the past decade. That's not inflation, that's devaluation. Your cash is a melting ice cube. Every year you hold it, it buys less. And with food inflation running at 6%, your purchasing power is eroding faster than ever. Okay? So maybe you think, I'll hold US dollars. At least that's the reserve currency. But the US dollar is being printed at unprecedented rates. The US national debt just surpassed $38 trillion. The government is running trillion-dollar deficits every year. They're not printing money to create wealth. They're printing money to service existing debt. That's not strength. That's a Ponzi scheme in slow motion. Fine. You say, I'll buy stocks. Stocks are ownership in real companies. But what are stocks really? They're pieces of paper that represent a claim on future earnings. And when those future earnings depend on consumer spending, and consumer spending is being crushed by food and energy costs, what are those earnings worth? Companies can't grow revenue when their customers are broke. Stock prices aren't rising because businesses are thriving. They're rising because there's nowhere else for printed money to go. The moment the liquidity stops, the stock market will implode. What about bonds? Government bonds are supposed to be the ultimate safe asset, right? But bond prices move inverse to interest rates. And if inflation stays elevated, central banks will be forced to keep rates high. That means bond prices fall. You thought you were safe, but you just locked in a guaranteed loss. What about real estate? Property values have soared, so surely that's a good store of wealth, except property values are built on cheap mortgages. When interest rates rise, mortgage costs rise, and the pool of buyers who can afford your house shrinks. You're not sitting on a gold mine. You're sitting on an illiquid asset in a rising rate environment. And if you need to sell, you'll find out very quickly what your house is really worth when there are no buyers. Do you see the trap? Every traditional safe haven has been compromised. Stocks depend on liquidity. Bonds depend on low rates. Real estate depends on cheap credit. Cash depends on stable purchasing power. And every single one of those dependencies is breaking right now. The liquidity tide is going out, and we are about to find out who is swimming naked. So, what actually holds value when the paper system fails? What exists outside the line of fire? This is where we need to talk about the difference between claims on assets and assets themselves, because there is a binary choice being forced on every person right now, and most people don't even realize they're making it. Do you own assets or do you own claims on assets? A stock certificate is a claim. A bond is a claim. A bank account is a claim. Even cash is a claim. It's a claim on the productive capacity of the economy. All of these are promises, and promises can be broken. In fact, they're being broken right now through inflation, through devaluation, through default in all but name. But gold? Gold is not a claim, it's an asset. It doesn't depend on a corporation's earnings or a government's promise. It exists independent of the financial system. The same is true for silver, for land, for physical commodities that you can touch and hold. These are not investments in the traditional sense. They're not supposed to make you rich. They're supposed to preserve the wealth you already have when everything else is vaporizing. And let me be very clear about something, because this is where most people misunderstand the argument. I'm not telling you gold is going to the moon. I'm not selling you a get-rich-quick scheme. I'm telling you that gold is stepping out of the line of fire. When currencies collapse, when stock markets implode, when bonds default, gold simply continues to exist. It doesn't gain value. The paper around it loses value, and gold becomes the measuring stick that reveals the loss. This is the money illusion that traps most people. You think you're getting richer because your portfolio says you're a millionaire on paper. But when that $1,000,000 can't buy what $100,000 used to buy, are you actually wealthy? Or have you just become a millionaire on paper while getting poor at the grocery store? Let me give you the convergence, because we're at the point where multiple structural faults are hitting at the same time, and the combined force is unlike anything we've seen in our lifetimes. We are facing a convergence of three distinct forces, and each one alone would be enough to destabilize your household budget. Together, they represent a mathematical certainty that your cost of living is about to spike in ways that will fundamentally alter how you live. Force number one, supply-side scarcity. The cattle herds are at 40-year lows. The droughts have decimated agricultural output. Climate volatility has made crop yields unpredictable. This isn't a temporary disruption that resolves in 6 months. This is a multi-year structural shortage of the basic inputs that produce food. When there is physically less food to buy, prices rise, not because of greed, not because of speculation, but because scarcity is real, and scarcity has a price. Force number two, currency devaluation. The Canadian dollar at 71 cents means that every imported item costs you 40% more than it would if your currency held its value. That loss doesn't show up in the inflation statistics the way you experience it, because the statisticians adjust for it. But your wallet doesn't adjust. Your paycheck doesn't adjust. You're paying the full freight of a weakened currency, and it's compounding every single day. This is what I call imported inflation. You're not just paying for rising prices in other countries, you're paying a currency tax on top of it. Force number three, The geopolitical wildcard. The trade war threat isn't hypothetical. It's already being discussed in policy circles. The tariffs are being drafted, and the moment they're implemented, you'll see food price spikes that make the current 6% increase look quaint. We're talking about 15%, 20%, maybe more on specific categories. And once those tariffs are in place, they don't come off quickly. Trade wars last year's. You'll be paying that premium for the foreseeable future. Now, here's what makes this convergence so dangerous. These three forces feed on each other. Currency weakness makes imports more expensive, which drives inflation, which weakens the currency further. Supply scarcity drives prices up, which increases inflation, which makes imports even more expensive. Tariffs reduce supply, which increases scarcity, which drives prices higher. It's a self-reinforcing spiral, and once it starts, it's very difficult to stop. And the government? They're powerless. They can't print more cattle. They can't print more rainfall. They can't print a stronger dollar. All they can do is print more currency, which makes the underlying problem worse. Every policy tool they have either doesn't work or makes the crisis deeper. So let me talk to you about the psychological component of this, because the biggest threat you face isn't the external crisis, it's your own mind's refusal to accept what's happening. Human beings are hardwired to believe tomorrow will look like yesterday. It's called normalcy bias, and it's kept our species alive for millennia. If the sun rose yesterday, you assume it will rise tomorrow. If the grocery store had food last week, you assume it will have food next week. This assumption works beautifully in stable systems, but it becomes catastrophic when the system is breaking. Right now, most people are experiencing cognitive dissonance. They see the prices rising at the checkout counter, but they hear the government saying inflation is under control. They feel their purchasing power eroding, but they see their investment accounts holding steady or even rising on paper. And the mind resolves this dissonance by assuming the personal experience is an anomaly. It's just my store. It's just this season. Things will normalize. But what if they don't normalize? What if this is the new baseline? What if the 71-cent dollar becomes the 65-cent dollar? What if the 6% food inflation becomes 10%, then 15%? At what point do you accept that the system has fundamentally changed and your old assumptions no longer apply? Let me give you a specific example of this psychological trap because I see it playing out in real time. There's a phenomenon called shelflation that most people don't even notice. You walk into the grocery store and the prices look similar to last month, but the quality has degraded. The vegetables are smaller. The meat has more gristle. The produce is closer to spoiling. You're paying the same price, but you're getting less value. The store is hiding the inflation by reducing quality instead of raising prices. And your mind accepts this. Because the price tag didn't change dramatically, you assume things are stable, but they're not stable. You're being slowly boiled, and you don't realize the water temperature is rising until it's too late to jump out. This is what I mean when I say the crisis is already here. It's not coming in some distant future. It's happening right now in slow motion while everyone is conditioned to believe it's temporary. The window for preparation is closing, and most people don't even realize there's a window. So what does preparation actually look like? Let me be very specific because vague advice doesn't help anyone. First, you need to understand what's happening to the official inflation statistics because they're designed to mislead you, not through malice, but through methodology. The Consumer Price Index includes things like flat screen televisions, which have gotten cheaper every year for 2 decades due to technological advancement. It includes used cars, which spiked during COVID but are now falling. It uses something called hedonic adjustment, which means if your new phone is better than your old phone, they assume you got more value, so they adjust the price down statistically, even if you paid more cash. But here's what the CPI doesn't accurately capture: the cost of survival. Food, energy, shelter, the things you cannot live without, are weighted in ways that minimize their impact. Housing costs are calculated using owner's equivalent rent, which asks homeowners what they think they could rent their house for. That's not what they're actually paying in mortgage costs or property taxes. It's a theoretical number that dramatically understates real housing inflation. So when the government tells you inflation is 2%, they're not lying. They're just measuring something different than what you're experiencing. They're measuring an average of discretionary and non discretionary goods. You're experiencing the inflation of necessities, and the inflation of necessities is running at 2 to 3 times the official rate. This matters because it means you can't trust the official numbers to plan your life. You need to budget based on your actual expenses, not on what the CPI tells you. And if your actual expenses are rising 6% on food, 8% on energy, 5% on insurance, you're looking at 10% to 12% real inflation on your cost of living, even while the government insists it's 2%. Now, here's the action item: budget for a $1,000 hit to your food costs this year. That's not a worst case scenario. That's the baseline forecast from the Canada Food Price Report. And if the trade war scenario plays out, budget for $1,500 to $2,000. I know that sounds extreme. I know it's painful to hear, but it's better to over-prepare and be pleasantly surprised than to under-prepare and get blindsided. Second, understand the protein premium. Meat is becoming a luxury good. If you're still eating the same amount of beef you ate 5 years ago, you're spending a significantly larger portion of your income on it. This isn't a moral judgment, it's a mathematical reality. You either adapt your diet or you accept that a larger share of your budget goes to protein. There's no third option. Third, recognize the currency dynamic. If you have savings sitting in Canadian dollars, you're holding a depreciating asset. Now, I'm not telling you to take reckless risks or put everything into speculative investments, but you need to understand that cash in a weak currency is not safe. It's slowly melting. If you can diversify into hard assets, into US dollar exposure, into anything that isn't purely dependent on the Canadian dollar holding its value, you're reducing your exposure to devaluation. And this brings me back to gold and silver, because this is the part where people either understand the argument or dismiss it entirely. Let me be very clear. Gold is not an investment. Gold is insurance. When you buy homeowners insurance, you're not expecting your house to burn down. You're protecting yourself in case it does. Gold functions the same way. You're not buying it because you think it will make you rich. You're buying it because if the paper system fails, if currencies collapse, if banks freeze, if inflation spirals, gold will still hold value when everything else is vaporized. Silver works similarly, but with an additional advantage: it's more accessible for small transactions. If you need to use precious metals in a crisis, you're not going to break off a chunk of a gold bar to buy groceries. But a silver coin? That's divisible. That's practical. That's the bridge between the old system and whatever comes next. Now, I know some of you are thinking, this sounds like doomsday prepping. This sounds extreme. And maybe it is. But let me ask you a question. If I'm wrong, what did you lose? You bought some gold and silver that held their value. You budgeted conservatively and ended up with extra savings. You diversified your assets and reduced your risk. That's not a catastrophic outcome. But if I'm right and you did nothing, you're trapped in a depreciating currency with no hard assets, no buffer, and no way to protect your purchasing power as it evaporates. You're standing in line at the grocery store watching prices rise every week while your paycheck stays flat. That's the risk you're taking by assuming everything will normalize. And here's the thing, the evidence is already here. The 994 grocery increase isn't a forecast, it's a certainty baked into the system. The 71-cent dollar isn't speculation, it's today's exchange rate. The cattle herd shortage isn't fear-mongering, it's documented by agricultural data. The trade war threat isn't conspiracy theory, it's in the Canada Food Price Report itself, labeled as a wild card. You don't have to believe me, you just have to believe your own grocery receipt. Let me close with this because I think it's the most important thing I can say to you today. We are living through a transition, not a correction, not a cycle, a transition. We're transitioning from an era where paper wealth was king to an era where physical assets matter again. We're transitioning from an era of cheap food and cheap energy to an era where the cost of survival becomes the dominant expense in your budget. We're transitioning from an era of stable currency to an era of competitive devaluation. These transitions don't happen smoothly. They happen in jolts, in shocks, in moments where the old assumptions break and people are forced to adapt in real time. And the people who adapt earliest pay the lowest cost. The people who wait until the transition is obvious, they pay a premium for everything because by then everyone else has already repositioned. History favors the prepared, friends, and the window for preparation is closing. Not next year, not next month, right now. The system is telling you what's coming through the grocery prices, through the currency weakness, through the supply shortages. The only question is whether you're willing to listen. You have a choice to make. Do you continue to hold paper claims on wealth, stocks, bonds, cash in a depreciating currency, hoping the system stabilizes? Or do you move into tangible assets that exist independent of the financial system's promises? I can't make that choice for you, but I can tell you that the cost of being wrong is asymmetric. If you prepare and nothing happens, you're slightly inconvenienced. If you don't prepare and the system breaks, you're devastated. The mathematics are already in motion. The 994 grocery increase is locked in. The currency weakness is accelerating. The supply shortages are multi-year problems. These aren't predictions. These are facts unfolding in real time. The only variable is how you respond. So I'll leave you with this. Your money is not safe in the form you think it is. Your investments are not protected the way you assume they are, and your cost of living is about to rise in ways that will force you to make choices you never thought you'd have to make. The question is not whether this happens. The question is whether you see it coming. Thank you for being here today, friends. Stay vigilant, stay prepared, and remember, the illusion always feels real until it doesn't.